Inflation, or the rate of change in prices over time. It's not a simple phenomenon to measure or interpret. If you've been paying attention to the news, inflation is a growing concern for investors and general citizens. And while this phenomenon has always existed in modern economies, the United States has not experienced high inflation since the early 1980s. According to officials in the Federal Reserve, the US has maintained an inflation rate of around 2% for nearly 40 years, which, according to experts, is perfect. However, in more recent months, there are many prominent investors who are warning of rising inflation in the coming months and years.
Now that the economy is rebounding and inflation pressures are rebounding.
So you've got prominent investors and even the White House warning of inflation, and various statistics that point to inflation becoming a serious problem in the near future. We'll go over these in a bit, but the most important topic we're going to discuss in this video is how you can use inflation to your advantage and profit from it in the near term. Many unprepared people are going to get wiped out by this arising issue, and if you can get prepared, you can actually do the opposite and make some money off this growing concern. So let's start with some of the warning signs. First, we're going to talk about the consequences of money printing. But before that, if you are enjoying this video, please help me out with the algorithm and smash that like and subscribe button. Now back to money printing. As you may have realized, we had the start of a large worldwide pandemic last year, which unfortunately led to the demise of many businesses and jobs. There were millions of people who needed money just to survive, so the government decided to step in and hand out some cash in the form of stimulus checks, loans, grants, and relief funding. They gave trillions of dollars to businesses that were struggling, billions to families and individuals, billions for medical programs, and billions more to state and public agencies. Now, this money had to come from somewhere, and it sure didn't come from some government savings account or treasure chest. The US has been in a budget deficit since the 90s, and its debt had already begun to pile up even before the pandemic started. So in order to finance this massive stimulus operation, the government did the obvious, and had the US Federal Reserve print the money out of thin air. All of our problems magically disappeared. Sounds too good to be true, right? Of course, printing trillions of dollars has consequences, sometimes very serious consequences. See, when you hand out free money in the form of cash to your population, they usually go out and spend more. This increases demand, and when demand increases, you already know the answer. Prices shoot up. Now that's a very simplified version of what happens, as this is just one ingredient that is part of a dangerous mix of variables that add even more pressure to prices. The other comes from the supply side. You see, right now many industries are facing serious supply chain issues that are preventing even the most basic items from reaching consumers. Try ordering a couch right now and you'll see what I mean. The wait times can be as high as 6 months. This decrease in supply is making basic items much harder to find, and when you add in the extra demand I talked about earlier, you get higher prices in a number of different industries. Take for an example lumber. Lumber prices have exploded over 300% in the months following the pandemic. If the cost of the materials needed to produce a good or service rise, think of the lumber needed to build a house, a business will pass on these costs to consumers in the form of higher prices. Economists call this cost push inflation. Finally, we have one last piece to the puzzle that is very unique to our situation right now. Obviously, as lockdowns end and more people get vaccinated, the pressures from sitting at home locked into rooms for over a year builds up. Pent-up demand for many service industries like hotels, sit-down restaurants, and air travel is building, and when there releases, high-touch services could surge and temporarily outstrip supply. This surge in demand, fueled by the savings many households accumulated during the pandemic, as well as relief payments from fiscal responses last year and this year, could very easily send many other prices soaring. This dangerous mix of variables has set the stage for what many experts are calling the post-recovery inflation panic. Here you can listen to Ray Dalio explain a bit of this.
Let's start right in and talk about the markets, Ray. There's been a tremendous amount of volatility this year. Why is that happening, and how do you expect things to pan out?
Well, it's simple. You know how the thing works. If the pulse of the economy goes down, then the policymakers, like doctors, rush to the patient and inject it with a whole lot of stimulation. And so what they did is they wrote out a bunch of checks, and they're writing out a lot of checks, which are about 5 to 7 times the size of the whole. and they got that money out. And what that did was, of course, the government doesn't have money. They get print money, so they have to borrow that money, but the Federal Reserve can print money. And so the same thing that is happening like on March 5th, 1933, is the same thing now in terms of that big stimulation. So the way it works is real interest rates are so bad, money's so cheap, and it's so abundant that it changes a lot of financial assets, and it causes those financial asset prices to rise. And when they rise, future expected returns go down to start to approach those of bonds and the risk-free return. And so that's what we've gone through. So you see it domestically, you see it also in the currency, in the dollar, you see it in other assets, gold, Bitcoin, and so on.
So the big question remains, how do we protect ourselves from the inevitable? How can we profit from this incoming wave of inflationary pressure? Most people watching this video right now have never experienced high levels of inflation before, so the answer may surprise you. We as a society are not used to having the dollar lose its purchasing power so quickly. One of the best ways to protect yourself and make some money is to buy real estate, specifically buying real estate with low interest, long-term debt. I know that answer may surprise you, but if you take a look at history, getting a mortgage before an inflationary wave is one of the easiest ways to rack up hundreds of thousands of dollars in profits. So you know by now that the worst asset class to have in this period is cash. Obviously, if the dollar is set to lose its value quickly, then you don't want it. So what is the polar opposite of cash? Debt. So instead of having inflation take away from your cash, it eats away from your debt. If you take out a $500,000 mortgage for 30 years, and for the sake of this example, the US dollar inflates to a point that $500,000 buys you a gallon of milk, well then paying off that mortgage becomes incredibly easy. You essentially got the house for free. Now this is an extreme example, but think of inflation as a way of shrinking your long-term debt. On top of this, you get the added benefit of your house value going up. Inflation raises the price of everything, including real estate. And if you ever decide on renting it out, rental rates go up too. So with just this one investment, you are profiting in various avenues. Now, if you don't have the money or the commitment to buy into real estate, you can substitute this with another asset class that has lower upfront cost, and that is commodity-based stocks. Certain stocks that revolve around commodities like land, steel, copper, gold, silver, or anything really that is heavily exposed to inflationary pressures is going to do really well. For an example, gold, which is a limited asset that cannot be watered down and has been used as a store of wealth for thousands of years, is going to shoot up in price during times like these, or at least historically it has in the past. If you own a mining stock that produces most of its income based on the price of gold, that stock will do extremely well under inflationary pressure. More recently, investors have also been rushing into a new type of investment. That is cryptocurrency, more specifically Bitcoin. Obviously, this is quite a controversial subject, as this new asset class is relatively unproved, only having been invented in 2011. But regardless, it is a finite asset that people are indeed flocking to in order to preserve their wealth. Bitcoin is limited to 21 million coins. The US dollar, on the other hand, as we have seen in the last 13 months, is not limited to any amount. The Fed can choose to print as much of it as it deems necessary. All of this is forcing people who are running away from the dollar to push their money into different assets that will preserve themselves better than the failing US dollar. Now, there are arguments whether or not this rise in prices we have seen with cryptocurrency is due to other factors, but a case can certainly be made that Bitcoin is at least partially seeing these massive inflows due to people chasing yields and protecting themselves against a devalued dollar. So we've got real estate, we've got commodity-based stocks, and we've got Bitcoin. Those are the assets that will do great in inflationary environments. Although we have never experienced something like this before, if we are able to learn from history and invest properly, we can actually profit from inflationary periods. Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed.